Joining me now is Solus Alternative Asset Management Managing Director Dan Greenhaus. And Dan, listen, we've been hearing this for a long time. Let's take a look at last week. So, for the week, small cap valued extraordinarily well. Up 1.4%, beat all the other sizes. Small cap core, 1.2. Large cap was down. Small cap growth outperformed large cap growth. Whoa, ladies and gentlemen. All right, maybe, is this, in your mind, are we starting to maybe see that little shift happening?
Yeah, I mean, I think over the last couple of weeks and really back to late last year, you've seen an increasing appetite for allocating capital and for greater returns away from the Magnificent Seven or Six, depending on how you want to look at Tesla. At the same time, in the short term, those companies still continue to outperform both fundamentally and technically, and I think there's still a need to be invested. If you're someone who's benchmarked to the index, if you're someone who generates fees by outperforming the S&P 500, you still need to be allocating capital to those names because they're so important to the index.
In a way, it makes you a de facto passive investor, though.
That's right.
Yeah.
You have practical passive investing, which is now called 55% of the overall market. And then also on the indexing side of things, money has to keep coming into these names. And also you have the average retail investor who generates an outsized portion of their returns from these names, as you mentioned, because a lot of the other names haven't been doing very much.
For the year to date, still extraordinary performance, growth up 7.5%, mid caps even 5%. Growth all over is done okay, right? Even small cap growth. These names that are deemed small cap value, the ones that don't have the maturity wall issue, the ones that are really making money, is it worth really trying to? You've got to really do your homework because there are obviously stocks in there that probably will be grand slams if you bought them right now, but you have to be selective, right?
Well, the thing for small caps in general is you have to do a lot of work.
Right.
For the average large cap stock, somewhere around 20 Wall Street analysts follow the average large cap stock. That's actually 5 for the average small cap stock, and somewhere around 10 to 15% of the index has basically no coverage at all. So there's ample opportunity there for the investment side of things, but to the point, again, there's been so much infatuation right now with large cap growth, there hasn't been too much room for anything else.
One of the big issues has been, do we want good news or bad news, right? Bad news means the Fed's going to have to come to the rescue. Good news means, well, maybe the Fed won't. And I always find it to be interesting because to me, the best case scenario for me would be a stock market that's built on great economic fundamentals for everyone, not the Federal Reserve pumping in a bunch of cheap money. Be that as it may, I saw this chart from Goldman. I thought it was pretty intriguing because essentially what they're saying is next year we could probably see about a little bit more. It's pretty 2 to 3% economic growth, and then of course the S&P 500 be up probably 8 to 10%. Is that a good scenario for you? And if that's the scenario, what would the role of the Fed be if that was the backdrop, the economic backdrop?
So for the average investor out there, the important thing to keep in mind is that economic growth is one of the prime variables when you're looking for forecasting stock market returns. Better growth, generally speaking, nominal growth correlates to nominal revenues for the S&P 500.
So we want to see this, the arrow going this way. We want to see that.
Yeah, better growth is better than the opposite.
But we kind of root for this sometimes. We want the GDP number to be weak. We want the retail sales number to be weak because then the Fed comes galloping to the rescue, dumping money out of helicopters, and you don't have to be a great stock picker.
Not that you're doing this, but people rooting for this are dumb. You should never be. Worse is worse, always. You always want better economic outcomes.
Right.
The Federal Reserve is a secondary player in the market in those instances. You certainly don't want to be relying on rate cuts, so to speak, to be generating your returns.
All right, so Goldman Sachs just raised their target to 5,200. It was 5,100, but not long ago it was 4,700.
Sure.
Wall Street's still reluctant, right? I mean, they're coming along for the ride, but no one, outside of Fundstrat and a few, have been really bold enough, maybe Yardeni, bold enough to say, hey, this is going to be a great market. And it seems like grudgingly they kind of nudge these targets up. In your mind, is that good or bad? I kind of like when Wall Street is not on the bandwagon.
Yeah, there's certainly no overwhelming enthusiasm from the Wall Street institutional side of things, which is where I spend my day. And I speak to a lot of these strategists. It's a job I used to have. No one's tripping over themselves to raise their price target. The problem that a lot of the strategists have on the street, guys and girls, is that so much of the index concentration right now is in those large cap stocks. Even though everyone sees this and knows that they're outperforming fundamentally, there's a hesitancy and a reluctance to fully embrace it because a lot of those valuations have gotten
crazy. For lack of a better word.
For lack of a better word.
Yeah, I think we go full circle. Here we go again. And so And 29 is just, and that's just, you know, somewhere even higher than that, right? The Magnificent Six.
Sure.
Just waiting for that to go up, I
But
guess.
now, mind you, they have a better valuation because they have better fundamentals.
Sure, these are great companies. These are not pets.com.
Well, you know, the funny thing about pets.com is it was a thing. It was just too early. We have pets.com today. It's called Chewy.
I hear you. Dan, great stuff. Appreciate
Thank you for
it.
your time, sir.